just because we call a follow through day doesn't mean that's your pedal to the metal signal. In bear markets, follow through days perhaps have a higher likelihood of failing. So talk to us about where you think we are in the
And we
market.
have seen some failed follow through days lately.
And we have.
Yeah.
Right.
I mean, if you go back to, I gave you some dates to punch into MarketSmith, maybe because it's easier to go back to. So this is my feeling is that I'm expecting a real follow through day when we get a verbal confirmation from the Fed that they are done or pausing this interest rate hiking cycle. And I want to go through historically, and I'm glad you pulled up the pandemic low. I've been trading 25 years. It really didn't resonate with me until about 5 years ago, the importance of that phrase, don't fight the Fed. It comes from the late, great Marty Zweig, who said, don't fight the Fed and don't fight the tape. And I always understood the importance of the Fed, but for example, in the pandemic low, we had those follow through days. It was April 2nd on the S&P and April 6th there on the NASDAQ 2020. That is when the Fed pumped in tons of liquidity into the system, all the bond buying that they were doing. They did more treasury purchases in the 6 weeks following that low than they did in the 9 years combined between 2009 and 2018. So the point is, insane amount of liquidity, keeping interest rates near zero, bond buying, and that's what led, all of those announcements led to that follow-through day, stressing the importance of don't fight the Fed. Now, really quick, if you reset today to show you the opposite of don't fight the Fed on the downside is right around December, January of last year in January, you see those big distribution days that came into the NASDAQ early, December, you can see that big volume down there. That's when the Fed did the opposite. So you don't want to fight the Fed when they're providing liquidity. All of the liquidity that they provided since the pandemic lows in a series of 3 announcements between December and early January, they announced, we're going to stop our bond buying this year. We're going to raise rates this year. We're going to take liquidity out of the system and possibly reduce the balance sheet. So in my view, the major reason for this correction is the Fed taking out all of that accommodation out of the system.
So that didn't change on Friday.
No, that didn't change. And we had a follow through day, one like on January 31st. There was another one in March, a couple in late March. I just claimed, I called BS on those follow through days because the Fed is still, you don't want to fight the Fed. They're still raising rates and fighting inflation. And to Justin and Ken's point is there's no stock setup. So that's what makes me I'll feel more comfortable when the Fed verbally announces some sort of pause to this rate cycle. And most importantly, also when we see more stock setup. And I'm happy to get into those historical examples whenever you want to pull them up.
Definitely.
Well, I have a question real quick.
Ahead,
so
Justin.
is one of your historical examples 2018 by any chance?
Yes, it is.
Okay, so I'm going to let you get to it because I was going to say, hey, here's a proof point too in terms of don't fight the Fed.
Okay, so type in date I gave you, that 4/24/2019. That gives you the whole picture of. So this is one recent example. Correction in the fall of 2018. The Fed raising rates, taking liquidity out of the system, talking about reducing their balance sheet, sound familiar, trying to get Fed funds to 2-3%, sound familiar. And then we had a valid follow-through day on January 4th of 2019 when Fed Chair Powell verbally said, we are going to be patient on raising rates. So this is a historical example of the Fed raising rates, doing exactly what they're doing now, and had a legitimate verbal follow through. And I told you to pull up that date to show what happened soon after that is we had the keyword being sustained uptrend coming up after that follow through day.
Yeah.
And 2 failed follow through days prior to that. So in November, you had 2 failed follow through days that they looked like they had the power. It was, everything looked fine, but they didn't work. And the good news was they immediately failed. So they didn't really give you too much temptation to go heavy because it was pretty swift how quickly they failed.
Yeah, no, that's a very good point. Now, one other quick example, if you go back to that next date, just to show you 2010. So we had the flash crash in May of 2010. And to Justin's point, 4 or 5 month correction with a couple of failed follow through days in June, July, somewhere in there. And the actual legit follow through day was September 1st of 2010. Ben Bernanke, the Fed chair at the time, announced at the Jackson Hole Symposium QE2. So this is an example stressing my point about fighting the Fed, really how it resonated with me. And I'm trying to, impress upon the viewers the same thing. It was when the Fed verbally announces in 2019 patient on rates, in this example, starting QE2, pumping liquidity into the system, verbally announcing some sort of accommodation. And the reason I had you pull up the date to show you the rest of that time, how we had, again, the key word, a sustained fall today. A sustained rally is my point.
Exactly. Okay. And then there's one more example.
And
that
you
we
did
can
have,
look at.
just real quick, you
Go
did
ahead.
have some really good setups there. CMG, Chipotle Mexican Grill.
Chipotle
broke out
so
on
many,
the follow through day.
Yep. Tons of
Netflix,
tightness. Lemon was another one that broke out.
Right.
You're right, Justin. That's such an important point, is you had the follow through day combined with stocks, growth stocks coming out of base and setting up. It's such a great point.
Yeah. And maybe there are some stocks that are, working on double bottom, still forming the bases on the follow through day. So I think that's another thing to think about too, is you're not necessarily going to see the breakouts on the follow through day, but you should be on watch in the coming weeks, right?
Sometimes they can take 6-8 weeks for them to form. So it's the great point that you can at least start to see them build the right side of their base around the follow through day.
Okay, and let's go to one more example. We have 1998.
There's so many examples historically. I'm just trying to go back to another one. When I was trading around the late 90s, you had a correction in the Russian debt crisis in the summer of 98. Long-term capital management blew up. And it was when we had that October 8th low, and when the Fed, or it wasn't just the Fed, it was all the global banks bailed out long-term capital. That was announced on that October 15th. So again, stressing the point of providing liquidity, accommodation, bailing out, whatever the reason is, it's a verbal announcement of the Fed or some sort of, accommodation. And that led to a very strong rally in the fall of 98. There's so many examples I can go throughout history, but my whole point of this historical lessons is to my gut feel is that we won't get a valid follow through day this time around until the Fed either announces that they're done, or at least, hey, we've done enough rate hikes. Let's pause and let that, get into the system, and let's see how it does as far as working its way into the system.
So when might we see that happen? How long could this play out then until they start saying those kinds of things?
That's a great question. Of course, no one knows. My speculation is they don't want to interfere with the midterm election year. So they meet every 6 weeks. Their next meeting is at the end of July. And then after that is September. So we have 2 more Fed meetings. I don't think they want to. You coincide that with the statistics that the average midterm election year bottoms around August, September. And you coincide that with they'll probably do 75 more in July. And then depending on what happens, if the market breaks, if credit spreads break, something like that, you might start to anticipate that in either the July or the September meeting, is my guess.
Okay. So then with all that being said, how are you positioned? Are you still taking small positions if you see, in the few setups that we have? How much are you staying back on the sidelines with not having the Fed in?
Well, I mean, to Justin and Ken's point, there aren't too many stocks, so I'm keeping a fairly heavy cash position and keeping things light because I'm still expecting volatility. I keep using that. I've said it since early April. I've said it on my blog. I went on TV. I've been tweeting about it. That keyword is we're not going to see a sustained uptrend. Can you see counter trend rallies? Can you see rallies back to the 50-day, 21-day? Of course, we don't go straight down in a bear market, but For now, I don't see anything sustained. So for my time frame, when I want to hold stocks for a few weeks, a few months, a few quarters, I'm just keeping things super, super light until I see the market health conditions improve.
Justin, I'll toss it to you on questions for Joe about follow through days.
Yeah. So there's a couple things that just in reading the Q&A and what we've been seeing. So first, Joe, with your cash position, being comfortable with a heavy cash position right now, one of the concerns that a lot of people have is they're like, well, gosh, isn't cash trash right now because of inflation? And they almost feel like, well, I've got to do something, because if I just sit in cash, I'm losing buying power. So what's your kind of take on that?
My take on that is you're not sitting in cash for like 15 years. You're not sitting in cash for a long period of time. It comes with experience. This isn't being cocky. It's just having the confidence that when we get a power trend sustained rally, and you're going to get a lot of stocks moving 10, 20, 30, 40%. I'm confident that, that whole, you make 80% of your money in 20% of the year, whatever the stats are. I don't mind sitting in cash, because for a few months, what else are you going to do?
Right.
I don't even care to collect dividends, because who cares if I got to collect a 3% dividend if the stock's down 30%.
Yeah.
So
yeah. No, I couldn't agree with you more. It's also that whole idea of protecting your mental capital, not being, thrown about, tossed to and fro. And then, by the time the real follow through day happens, you're like, oh, I'm not going to believe this one. Forget it. I've been tossed around too much.
Oh, that's such a great point, protecting mental capital, because when the real follow through day comes, you want to be mentally ready for it. Absolutely.
Yeah. Now, one other thing is, with the importance of the Fed and what the Fed says, has there been any shift? Because the Fed has been saying a lot of things that haven't really, oh, this inflation is transitory, or, oh, the 75 basis points, that's off the table, type thing.
Can we really trust them when they start?
I know they don't have much credibility, and I know that my feeling, not that the market cares what I think, but they stayed their welcome too long when employment got back from, I understand a once in a century pandemic, doing what you have to do to protect the markets. I get that. But when retail sales was back above, employment was back above trend, and the economy was coming back, I think they waited too long to take away that accommodation. And that might have been part of the reason that led to some of this inflation, of course, with supply chain issues and so forth. I really hate to overthink the macro. I'd rather keep it simple. And I think you do need to get some verbal confirmation from them. But most importantly, to the points you guys have made, is you got to have some viable merchandise, some more stock setting up and sound, healthy basis.
So last question here, with the Fed, with your projection, and I like the idea, because again, if we're thinking October, then there's a lot more data that can come out by then, right? And kind of show one way or the other where the projection could be. But are you thinking that the market takes another leg down, or a lot of these examples that you showed, we saw kind of that sideways, how it came down, and then a lot of sideways chop and slop action before it finally had that follow through day. And of course, one of the benefits of some of that sideways action is that you can be forming bases a little bit more. Do you have a projection on that? Like, do we go down further, or is this maybe the bottom, but not necessarily the sustainable rally that people may be looking for?
Yeah, I mean, it's something I'm not sure about, to be honest. I think it's one or the other, either that U bottom where we don't necessarily have to go lower, but it's chop. So the key word is nothing sustained to the upside. So could we have a leg down? I'm open-minded to that. Could we just chop around in a range and build a base? I'm open-minded to that as well. But if people are wondering, hey, do I expect another big leg down? I don't know. I'd rather just be open-minded. I love one of Stanley Druckenmiller's line. He said one of his greatest assets in the last 30 years is his ability to change his mind quickly. So we take this day by day. I'd rather be open-minded and just take the information as it comes.
Yeah. And I'll say that's one of the things I admired the most about Bill O'Neill was, I mean, we just saw so many times where he could be super bearish and, send note out to clients and everything like that. And then the next day, oh, I'm buying. It's a follow through day. Forget what I said yesterday.
It's called flexibility. It's called humility. It's called not having an ego. It's called not doing what you think the market should do, but what it's actually doing. And those are like beyond admirable traits in any trader and any investor.
Hey everyone, thanks so much for watching Investors Business Daily on YouTube. If you want to watch more videos, make sure you hit that subscribe button so you don't miss a thing.